Good afternoon, everyone. Welcome back to another bar by bar analysis here on my channel. Today is May 6th, 2022, and today we're looking at a 2000 tick chart for the E-mini S&P 500 futures market. As we've been doing the past few days, we've been kind of trying to figure out this new strategy to trade, trying to figure out rules on how to standardize it a little bit and make sure that we're not cherry picking trades. We're trying to get a strategy together that is profitable and consistent in the long run. Now, I got a comment yesterday talking about how I need to be marking up my charts more and stuff. And, usually when I do these bar by bar analysis videos, I just wipe the chart completely and I go through and I have to remark everything and I don't always remember everything. But during the day, I definitely mark up my charts a little bit more. And so I think today's video is going to be a little bit different. We're going to be talking through some of the trades today and go over some of the things that I've thought about, some of the things I've discussed with other people in terms of how to go about approaching this catching loss strategy that we've been trying to work with. Now, before I start, I need to talk about a few things. One is the indicators that we're using. So we are using a 21 indicator here in blue, a 200 EMA here in magenta, and introducing a 9 EMA in cyan. Now, the purpose of this 9 EMA is twofold. One, it kind of helps us out establish, when we're in congested areas here. If the 21 EMA is flattening out, you also have the cyan 9 EMA flattening out. That could tell us, hey, we're in a little bit of congestion. Additionally, it helps let us know when we need to be taking out our orders from the market so that we don't get into trades. And we'll talk about that throughout the video, but just to preface, introducing this 9 EMA, it also helps try and figure out things on a smaller time scale. So, what I mean by that is this 200 EMA, what is this telling us? This is kind of giving us a general overview of what prices are doing. This is the big picture, 200 EMA. Now, as we kind of dial it in a little bit, we use the 21 EMA to help out with entries. First, second entry longs, second entry shorts, failures, stuff like that. The 9 EMA, when we're in downtrend and we're in a strong trend, the 21 EMA isn't always something we can rely on just because prices are pushing so far from the EMA. Prices never come back and we could be missing out on opportunities. So with this 9 EMA, it kind of gives us a better idea of how strong the market is trending, as well as when we need to be getting out of our trades. One more indicator, and I'm not going to try and confuse a lot of people with it, but the MACD has been helpful. I've been secretly using it the past few days, seeing how trades have worked, how have they not worked, utilizing the MACD here, and I might touch on it a little bit, but I'm going to, maybe I'll keep it open so that people can see how the MACD responds with the trades that we take throughout the day. But I don't want to confuse people with it. It's something I'm still trying out, but for the record, I have found it beneficial to use. So anyway, as we go through the chart today, the chart will be marked up. Prices were trending in this range before pushing strongly down to the bottom of the range here. And this is a good opportunity to show exactly what the MACD is doing. So the MACD obviously likes to oscillate up and down. And you see these segments where bars are oscillating below the MACD, prices are trending downwards. And when bars are trending above the zero line for this MACD, prices are somewhat trending upwards, and it just oscillates back and forth, back and forth. And sometimes the crossovers that we have here for the MACD give us an indication of where the momentum is changing. So we're in this downtrend as MACD is pushing down, and as it comes back up and crosses over this zero line, you see prices start to increase again, build a little bit of momentum. Anyway, that's the brief overview. We're not going to get too much into it today. Again, it's just something I'm trying out, so don't let it distract you. Let's focus on the bars and price action, overall context of the market in order to take our trades. Now, this first trade I didn't take, but if you managed to take it, you would have gotten a very nice runner. I think prices went down 10, 20 points. You could have gotten a lot of money off of this runner, but it is somewhat of an aggressive entry. EMA is flattening out with a lot of overlapping bars up and down. We're in a little bit of congestion here as prices are trying to figure out what to do. You have a new high, first entry long, second entry long if there's a trigger above this bar, and there is. So you got people that are long into this trade. If you want to catch people's stops, you'd put your stop limit order one tick below the signal bar, and as prices come down, you would have been in this trade and flushed to the downside. Now, I personally stayed out of this trade for a few reasons, one of them being that the EMA was relatively flat, but also because, market just opened. I wasn't sure exactly where prices were going to go. We had this big downtrend working down with a break new low. So this downtrend had played out. But if we're in this trading range, we're anticipating for prices to work their way back up to the top of this trading range. So I just kind of wanted to sit on my hands. But for those that are looking at the MACD here, you kind of see a slight loss in momentum, potential crossover here. And as prices work their way down, you have the first bar that prints below the zero line on this MACD. And that's pretty much where you're entering. You're entering one tick below to catch people's stops. And as the next bar prints, you're flushed in and out of that trade based on that MACD crossover. Now, this is the trade I liked. Prices came down. People tried going long off the lows. I was thinking to myself, okay, if people end up getting that trade and it works in their favor, awesome. But I wanted to enter one tick below this signal bar and catch their stops. And as prices came down, I was in and out of that trade very quickly as prices flushed down. Now, I didn't mark it here, but as prices continue down, you do have this new high with the first entry long, second entry long if there's a trigger above this bar. And there is, it ticks up one and reverses. If you put your stop limit order one tick below this signal bar right here, you're going to catch that move and ride prices down. You probably would have had a very nice runner there. Now, when we're in this opportunity, when we're in this position where we have our market order prepared, if any bars close above this 9 EMA, we're pulling the order. We're not going to enter that trade. So as we fast forward a little bit, we have this trend that's working down with a break move to a new low. This downtrend has played out. Prices chop around a little bit in this range, waiting for this 21 EMA to catch up. And as the EMA catches up, if we trade it down into this trading range, we're most likely to trade down and out of the trading range. We have this new high up here as prices come down. First entry long, prices continue down. Second entry long trigger above this bearish bar. Additionally, let's look at what the MACD is doing. The MACD is oscillating from the swing high. And as prices come down, there's a crossover there. And as the MACD works, we oscillate down, up, down, up, most likely going to oscillate back to the downside. You put your stop limit order one tick below, you enter that trade, and you flush out for at least a scalp. Now the MACD isn't perfect. You see as prices continue on a little bit, we don't go as low as we thought we would have. So, if you want to have a MACD on your chart just to kind of reference and look at, you can. But again, it's something I'm still experimenting with and learning. And so it'll probably take a little bit more time for me to truly get comfortable using it, incorporating it with the rules. Now, I have a note here, talk about why 9 EMA is important, otherwise you lose this trade. So if you had asked me a few days ago, are you going to take this trade? I'm going to say yes, I'm going to take this trade. I would have. And why? Because we have a new high. First entry long, prices come down. Second entry long, people are going to try going long above this bar. So I'm going to put my stop limit order one tick below the signal bar here and catch people's stops. Well, what happens is prices continue. I'm not into this trade yet. My order is still here. Prices continue to work up. My market order is still here. They continue to work up. Prices hold at EMA, they come back down. I'm in this trade and then prices reverse and stop me out. So what keeps me out of a trade like that? Well, what I'm going to do now that I have a 9 EMA is I'm placing my stop limit order one tick below the signal bar. Now, as prices work along, we don't have any close above 9 EMA right there. As soon as we get an up close above this 9 EMA, I'm taking my order out. I don't want to be in this trade any longer, or I don't want to wait for this trade to play out. That's going to keep me out of these nasty trades that tick down and trap me and then come back up and stop me out. So a few people were introducing the 9 EMA to their charts. They let me know about it, and I really liked that idea. Now, you'll notice, as prices were consolidating a little bit, you don't necessarily have this trading range at play, but you do see the MACD is oscillating very slow, down, up, down, up. So very hesitant about taking any trades here. Eventually prices trend up. We find the top of this trading range and prices do push up and out of this trading range. Now, this 200 EMA is coming down. If there's a trigger below this second entry short, if a second entry short triggers below this bullish bar, are we going to enter long above this? Probably not, because we have the 200 EMA working down. Prices are trending down. We have to just be cognizant and careful about where we're taking these trades. So there is a trigger down. We have our stop limit order in place. And as prices work down, there's our close below the 9 EMA. We're taking our trade out regardless. So that's how that 9 EMA works. Now, another way that you can use the MACD is by analyzing where the highs and lows are for the swing. So again, as we mentioned, as prices are above the zero line for the MACD, we find the highest point within this bracketed range that we have here. And the high would be right here. So that's a high. We can also mark the lows as prices come down below the zero line of the MACD. We find the lowest point and mark the low. I gotta try and change the colors here so that it doesn't confuse people. So we have a high, we have a low based on the MACD indicator. prices swing up again. We have a high right here, and within this bracketed region, prices swing down here. So we have a high, we have a high, we have a lower high, we have a low, and a lower low. Now, why am I pointing this out? So let's continue understanding what's going on here. Within this bracketed region, we have a higher high, prices dip down. Just sliding things over here, we have a line that marks the low. Prices come all the way up in this bracketed region. Now we have a higher high. Then we slide this bar over, marking the low of this bracketed region in the MACD. And now we have a higher low. Now this is really important. Notice what happens with the MACD. We had a low marked in this region and a lower low that was marked on the MACD. But on the chart, prices have a low and a higher low. So that's when I put this line here to indicate prices are moving up while the MACD is showing a divergence in prices. They're going opposite ways. And now how does that help us? When prices and MACD are not lining up, that's leading to instability and a possibility for prices to reverse. Now the MACD is used in stocks, it's used in forex. There are plenty of convergence, divergence strategies. I don't want that to be a focus on this channel, but I'm just illustrating this is how the MACD could be beneficial, because what ends up happening is our bias changes. Rather than focusing on trying to go lower, we start thinking about possibly going long. We have this new low with a first entry short, second entry short that triggers below this bar here, and it's a doji bar, but you enter one tick above this stop limit order. You place your stop limit order one tick above this signal bar, and as prices come up, you're in and out of that trade very quickly. And not too much farther later, we have a new low with a first entry short, second entry short if there's a trigger below this bar, and there is, and then prices immediately reverse. You enter one tick above the signal bar here, and prices stall just a second before they continue up, and you're out for the scalp. So yes, you have a 200 EMA working down, but you have to notice we're making higher highs and higher lows. We have this big downtrend that's losing momentum. Prices are not pushing to the opposite end of this channel here. And additionally, the 9 EMA is holding prices fairly well. With our stop limit order one tick above the signal bar here, we never get a close below that 9 EMA before prices rally up. The other thing to mention is the MACD. There's a crossover that's happening right in this area. So prices are crossing over after this bearish move down. Prices were moving down, and as momentum is building up, you get this crossover right here. That just adds to the confidence in the trade, because again, prices are oscillating up and down, up and down. Where are we supposed to go next? Right here to the upside, and we hold that momentum all the way up as prices move up. And we're in this trading range for a bit. We came across this second entry long here, but I was hesitant to take it. I mark this as a risky one just because you're going short into the lows of this trading range. We're also at these overnight lows that we marked earlier when the day started, so I just found it fairly risky. But if you're going to enter this, you wait for prices to tick up one, and as prices reverse, you're entering technically below this signal bar where people's stops are. Now, I don't think it actually happened like that. I actually think bars pushed down first and then finished closing above EMA. So technically your stop order would go one tick below the signal bar. But when we start having a close, when we had this close above the EMA, you probably need to take your stop limit order out in order to abide by the rules. And what happens? Prices come down, you're in this trade, and they push down for the scalp. But again, a little bit aggressive for those reasons. So prices trade down before pushing strongly above EMA. I didn't really find anywhere that I wanted to enter during this time. We're in a bit of a range here. You have a new high first entry long, second entry long off EMA. If you're looking to take a second entry long, you could take one there. You're also buying at the lows here, looking to sell at the highs. Let me delete this. That's not important. So as prices are coming up, we have this new low first entry short, second entry short if there's a trigger below this bar. And if there is, we could potentially look at going long. You know, if there's a trigger above this bar to catch the stops. But the MACD was thinning out just a little bit as prices were trying to figure out what they were doing. So while you don't see congestion here, it could technically be found in other ways. And so if you're able to recognize that, you can just be patient and you stay out of a trade like that. But if you don't have the MACD up and you see a trade like this, I mean, realistically, you have to take it. It makes sense. because you have this new low, you have a first entry short, second entry short. As long as there's no close below this 9 EMA, you go long and catch the stops. But what happens is it ticks down, comes back up, and it stops people out. And that's fine. It's part of the strategy. That's what happens with any strategy. But yeah, you're not going to be able to avoid all losers. Sometimes it happens. Now, there were a series of trades I started to take later in the day. I was utilizing a stop strategy where once prices move 4 ticks, I bring my stop loss to break even so that I can't lose money on the trade. Either the trade works right away or I'm out. So there were a number of trades I took in the afternoon. We're going to go ahead and cover them here, where I end up getting stopped out because of the stop loss strategy I have, but these trades would have worked. So we have a new high, first entry long, second entry long. This one's aggressive just because the 9 EMA is still above the 21 EMA. I think I have a trade illustrated later, but it's better to wait for this 9 EMA to cross over the 21 EMA and show that there really is bearish pressure before you're looking to go short. So I had my stop limit order 1 tick below the signal bar. Prices came down and filled my order before coming back and stopping me out for break even, and then prices worked exactly where I thought they were going to go. So depending on your stop loss strategy, you either were in this trade or you got knocked from this trade. Now this horizontal line here I marked, and I don't think I marked it for all of the trades that I took, but this is another stop loss strategy. Is if you're entering 1 tick below, where are you going to put your stop loss? Rather than putting it above the swing, you could put your stop loss 1 tick above the bar that you entered on. So for example, with this trade here, we have this new high, first entry long, second entry long. As people try to go long, you wait for the trigger. There's the trigger. EMA starting to cross down below the 21 EMA. This trade is one that I'm more comfortable taking. I put my stop limit order 1 tick below the signal bar. And where would the stop loss go? Technically, it could go 1 tick above the signal bar entirely. You're not in this trade yet. There's never a close above the 9 EMA. And as prices come down, you're flushed into this trade and potentially out for a scalp. Now that you're in this trade, your stop loss is going to go 1 tick above this signal bar here. And that's just to protect you in case prices really do come back. But yeah, I mean, I was stopped out break even because of my stop loss strategy, but prices came down and made the 2 points. So that would have been a winner for me. But it's all good. I'm just continuing to refine the strategy and learn what works for me. Also, not to mention, as prices were coming down, right, you're entering short below this bar, and you notice the bearish movement of MACD. You don't know exactly when it's going to curve the other way, but if you're entering short when the MACD is showing this bearish momentum, it doesn't hurt having that extra confluence, the extra confidence when you're taking trades like that. So as MACD starts to round out, we start pushing up into bullish territory. We have a crossover there. We also have this new low, first entry short, second entry short if there's a trigger below this bar, but we don't get it until boom, right there. And that's, I mean, you saw where my arrow was marked, but the second entry short triggers right there. So people are trying to go short. I have my stop limit order 1 tick above the signal bar. We had the crossover as the MACD is pushing up into bullish territory. And as prices come up, you're in this trade and out for a scalp. So again, the catching stop strategy works out great. You get in and out of the trade with a nice scalp. Now this is the trade I was talking about where we have to wait for 9 EMA to cross over. So notice how this 9 EMA is above. It's very strongly above this 21 EMA. We have a new high here with a first entry long. Prices come down for a second entry long trigger above this bar. So people are in this trade trying to go long. If you put your stop limit order 1 tick below this signal bar, you're waiting for the entry, waiting for the entry. There's the bar where you get sucked into this trade and prices come back to stop you out before pushing exactly where you think they're going to go. And look at what the 9 EMA is doing. The 9 EMA is still coming down, still coming down, still coming down. And as soon as we get that crossover, now it's crossed over. Now there's bearish momentum. That's when you ride it all the way down. So we have the right idea about catching the stops, but prices needed to come back up a little bit more, gather more people that were trying to go long before they could get trapped. So this is one of those nuances. Wait for the 9 EMA to cross over the 21 EMA before you try trading that catching stop strategy. Now, unfortunately, you don't really get a chance to get in here. You know, even if you put your stop loss 1 tick above where you entered, as prices came up, you would have been stopped out. All right, we do have a few more trades left as prices push strongly below this 21 EMA. They break, try and form a new low here at the bottom. We anticipate for prices to push back up to the top of the trading range. We have this new low with a first entry short. Prices come up for a second entry short that triggers below this bar, and prices immediately come up. You could enter one tick above this signal bar, but it would be smarter to wait for the 9 EMA to cross over the 21 EMA first, just like we did up here. So we got to be uniform with the rules. This is definitely more of an aggressive trade. Does it work out? Yes. If you entered your stop limit order one tick above this bar, prices would have came up and got you for the scalp, but it's aggressive. It didn't work here. It did work here. But if you're patient with it, you'll see the setups for this happen quite frequently because we have this strong push right here with this new high. First entry long, second entry long if there's a trigger above this bar. Prices came up and then immediately reversed. Were people putting their stops one tick below the signal bar where they entered? This flushes down for a nice scalp very quick. Now here's this line again. Here's the line on the MACD again. I noticed it again. So of this whole bracket in the MACD, we're going to mark the lowest point, which is right here. So that marks the low. Now prices come up in this bracket, you get a high, but that's not as important. If we're focused on the lows, we're going to mark the lows. On the MACD, you notice there's a higher low that presents itself. So we have one trend line that's working up, but then when we look at the prices, we have a low and a lower low based on where that low is supposed to be in accordance with the MACD. So now we have convergence. And when we see something like this happening, when we see this convergence, that's most likely telling us that prices are going to reverse. And you can go back, look at the chart, look at the MACD, and test that theory, but I know it is used very often in the market, and I feel it could be used when trading futures as well. But prices do push strongly up and then immediately come back down very strong. And this was my final trade for the day. We had prices working down with a break move to a new low. So this downtrend has played out. My thought process was we're most likely going to make it to the other side of the trading range. Strong push above EMA. New low for a first entry short, second entry short. There are people that are going to try shorting up here, and they do. Now there are people that are trapped in this trade. As long as we don't get any bars that close below this 9 EMA, I'm keeping my stop limit order in place. Additionally, we have a new high. First entry long, second entry long if there's a trigger above this bar. And there is. As soon as that triggers, now you have people in a second entry long. I'm catching stops from the people that are trying to go short. I thought for sure this trade was going to take off. Now, unfortunately, prices come back and stop me out for break even. And if you have any other stop loss strategy in place, you most likely would have been stopped out on that trade. That's just a very unfortunate trade to take. You know, even the MACD is showing a lot of bullish momentum, so it's kind of hard to stay out of that trade. That's just one that you would have lost if you don't have a decent stop loss strategy in place. But anyway, that's going to be it for today's video. I didn't look at prices the rest of the day, but even post analysis, you can kind of see as prices push up and then back down, we're waiting for the 9 EMA to cross over the 21 EMA. And as it does, that's when we can start looking to catch stops. We have this new high of the swing, first entry long, second entry long. People are trying to go long. As long as we don't get any closes above the 9 EMA, where are we going to put our stop limit order? One tick below the signal bar. And as prices come down, you catch the stops and you ride that momentum. Additionally, you look at the MACD, you have nice bearish momentum pushing downwards. That's a trade I would have taken if I saw it in the moment. But anyway, that's going to be it for today's video. I covered a lot of stuff, and I know a lot of people might not appreciate all the information, and that's completely fine. You don't have to use everything I'm using. Trading is a very personal thing, and as long as you're making money doing it, don't change anything. I'm just continuing to fine-tune my skills so I can really maximize my profits and minimize my losses. That's literally all it is. So if you're not a fan of the MACD, if you don't think it's going to be helpful, then don't use it. It's completely fine. But I do think with this strategy, having the 9 EMA is very important because it's a technical indicator that gives you a clear-cut answer of when you need to be pulling your trade out of the market. Otherwise, you're just eyeballing it. You're thinking to yourself, oh, the scalp was already made. I'm just going to pull my order. I don't necessarily think that's the correct way of going about it, only because people scalp for more than 4 ticks, 6 ticks, 8 ticks. You know, a majority of people probably have their profit targets around 4 ticks, but not always. So rather than eyeballing it, let's get another technical indicator that's going to seriously help us navigate that one dilemma that we have. Anyway, it's all a process. We're continuing to learn every day here as we work on trying to master this market and become profitable traders. Take the time to like the video, subscribe. I hope that you guys stick around. Comment down below. Let me know exactly what you thought about this video today. You know, do you agree with these methods? Do you not agree? What are you going to do differently? What takeaways can you you gather from a video like this. I did want to put out somewhat of a bigger video like this just because it's Friday, it's the weekend, people can digest the material. But yeah, we'll have normal videos again next week. This was kind of just a once over the world of how I've been using the MACD for the past week alongside this stop loss strategy. I appreciate all of you for watching, and I hope you guys have a phenomenal weekend. I'll see you guys later.